When you hear the name Warren Buffett, it's easy to picture some kind of oracle, right? A market wizard who just magically picks winning stocks. But that whole myth, it completely misses the real story. And what Buffett actually built is way more interesting than magic, because it's a system we can actually break down and understand.
So, what is the real secret? How did one person build one of the most valuable, most admired companies on the entire planet? Well, it turns out the secret wasn't really a secret at all. The answer isn't some secret formula he kept locked away. It's a blueprint, a durable, repeatable, and frankly learnable system for compounding money. But it's more than that. It's a system for thinking rationally about business. And in this explainer, we're going to deconstruct it, piece by piece.
Okay, just a super quick heads up before we dive in. This is all for educational purposes. It's not financial advice, and of course, all investing comes with risk. Always do your own research.
So first up, we have to go back to the beginning, the making of the investor himself. To really get the blueprint, you have to see just how deliberately it was built, starting when he was just a kid. This was no accident. This was the careful construction of a mental operating system for making decisions.
And the seeds for this whole thing were planted super early on. At just 11 years old, he buys his first stock, sells it for a tiny profit, and then has to watch as it skyrockets without him. Ouch. That was an immediate, painful lesson in patience. Fast forward to 1951, he's at Columbia, learning from the father of value investing, Benjamin Graham. That gave him his core intellectual framework. And by the late 50s, he's already in the game, running partnerships, improving his ideas in the real world.
Now, Buffett's real genius wasn't that he invented everything from scratch. Nope! It was in combining different, powerful philosophies. From Ben Graham, he got the math, the whole idea of a margin of safety, which is just a fancy way of saying buy something for way less than it's actually worth. Then from Philip Fisher, he learned to appreciate quality, to focus on businesses that could stand the test of time. But the crucial upgrade, the real game changer, came from his partner, Charlie Munger. Munger convinced him to shift from buying just cheap businesses to buying great businesses at a fair price. And that combination, that became his unique operating system.
So the takeaway here is that his system, it wasn't built on some crazy complex algorithm. It was built on a sound, logical process, a very long-term view, and this is the key part, having the right temperament to actually follow the rules, to stay calm when everyone else is freaking out. The system was simple, but sticking to it, that was the hard part.
Okay, so he's got this killer philosophy. But a philosophy is just an idea, right? You need a vehicle, an engine, to apply it at a massive scale. For Buffett, that engine became Berkshire Hathaway, a true compounding machine. And at the absolute heart of this machine is a concept called insurance float. It's actually a beautifully simple idea. Think about it. You pay your insurance premium, right? Well, the insurance company gets to hold on to your money for a while, maybe even years, before they have to pay out any claims. That giant pool of money they're holding, that's the float. And they can invest it for their own benefit. For Berkshire, this became a massive, low-cost river of capital that fueled everything. It's the engine of the whole enterprise. And just look at the sheer scale of that engine today. In recent years, Berkshire's cash pile has ballooned to hundreds of billions of dollars. But listen, that number isn't a sign of fear. It's a signal of incredible discipline. It's the byproduct of a machine that generates more cash than it can find rational places to put to work.
And this gets to a really core idea of how Buffett thinks about his job. His main product, it wasn't insurance or candy or railways. His core product was intelligent capital allocation. The single most important thing he did every day was deciding where to deploy that massive pile of cash for the best possible long-term returns.
All right, so we've got the philosophy and we've got the machine. Now let's see how this thing actually performs on the road. We're going to look at the wins, the losses, and the incredibly valuable lessons learned along the way. This is the system in action.
His biggest wins, they were never just lucky shots. They all fit a very clear pattern. Think about Coca-Cola's unbelievable global brand, or American Express and its powerful payment network, or, more recently, Apple and its consumer ecosystem where the switching costs are immense. Totally different businesses, right? But they all fit that same repeatable model of quality, durability, and a strong competitive moat. And, well, here's the scoreboard. This is what happens when you apply that system patiently, over decades. It didn't just beat the market, it created one of the most staggering records of outperformance in the history of finance. That's the power of a rational system.
But the full story isn't just about the home runs. A huge part of Buffett's credibility, and a huge part of the blueprint,
comes from his incredible willingness to talk openly about his mistakes. And those lessons are often just as powerful as the successes. And what's fascinating is that his mistakes were almost always the exact opposite of his winning principles. He fell into the cheapness trap when he bought the original Berkshire Hathaway textile mill, a terrible business. He made a disastrous compounding error when he used valuable Berkshire stock to buy Dexter Shoe. He totally misread the energy cycle with ConocoPhillips. In a way, every single mistake just reinforced the importance of his core rules.
And this brings us to maybe the single most important lesson of all. Buffett's real edge wasn't being right 100% of the time. Nobody is. His real edge was survivability. He made plenty of mistakes, but he structured things so that no single error could ever be fatal. He never made a mistake that could break the compounding machine.
Okay, so for our final section, let's zoom out and talk about the Buffett blueprint and what his true legacy really is. Because honestly, it's so much bigger than just the financial returns. He fundamentally changed the entire culture of investing.
I mean, just think about the cultural shift. In a world of frantic trading, he made it cool to be a long-term business owner. He took corporate reports filled with jargon and replaced them with plain English that anyone could understand. He taught millions of people that your temperament, how you behave, is a real competitive advantage. And he forced an entire generation of managers and investors to focus on capital allocation as the ultimate test of a CEO.
So if you boil this entire, incredible career down to its absolute essence, you're left with these three crucial interlocking pieces: a sound, logical process, a truly long-term horizon to let that process work its magic, and the right temperament to stick with it all through the good times and the bad.
So if you take just one thing away from this whole explainer, let it be this. Warren Buffett's true, lasting legacy isn't Coca-Cola or Apple or any single stock pick. It's the blueprint itself, a clear, rational framework for compounding both your money and your knowledge over an entire lifetime.
And that leaves us with one big, fascinating question for the future. As Berkshire Hathaway enters its next era, at a scale that is almost unimaginable, can this culture of rational, patient, disciplined capital allocation continue without its original architect? The blueprint has been written. Now we get to see if it can be copied.